back to another episode of Policy and Profits. I'm EJ Antoni. I'm joined by the one and only trader extraordinaire, Anthony Esposito. Anthony, how are we doing this week?
I am winning at life. I never get tired of hearing that intro, so thank you. And very happy to have been with you in person earlier in the week down in Houston for the U.S. Oil and Gas Association board meeting. That was a pleasure to see you and hang out a little bit and do
Likewise.
a little bit of a policy and profit presentation to the board. So very cool. Thank you for that time. I know your time is very valuable, so I appreciate it.
Same to you, my man. Same to you.
How was the flight back? I heard there was a little conflict, little trouble.
Oh, not the best. First flight got canceled. Second one was delayed, and then as we're descending down into Reagan, they wave us off saying, "Sorry, we can't clear the runway of snow fast enough." So then we go to BWI, and right before we're going to land there, they say, "Oh, we're out of gates. Sorry, no more flights can land tonight." And they send us out to Dulles, and then it was a very long, very slow Uber trip in a snowstorm from Dulles to Reagan. So it was a late night, but I think it was a late night for both of us getting back to the Northeast.
Yeah, the trip back. Mine was expected to be late. I had a later flight. They did okay with the snow. We got out, landed in Philly, and got home by midnight, a little after. But definitely worth the trip. Great group of guys there, and guys and girls. I say guys for everybody, but definitely a great group. And at the forefront of energy production and exploration and refining in the country domestically. So it was interesting to sit with them and kind of have that conversation. So the big ticket items, I think today we're going to flip. We're going to do profits and then policy, which is not normally what we do. But the big item of discussion, which all of a sudden has come back to the forefront, which probably never left the forefront or shouldn't have, is inflation. We had last week a little bit of market action off of the University of Michigan 1-year inflation expectations up at 4.3%, which was pretty hot. Yesterday, we had the CPI data come in hot again. So we had core at 3.3% and then CPI year over year at 3%. So hot once again. Show a little market action on that after we go through. So coming off of that CPI print, we have a chart of exactly how fidgety and how manic the market can be. We actually have that S&P. I was trading the E-mini futures on the S&P 500 as that tick hit. We have that 3-minute bar chart, or that 30-minute bar chart I think I threw up to show kind of the ridiculous action. So that big blue bar down was 30 minutes following that report. So again, I keep reiterating this, and I think it's important to talk about. We're at all-time highs, and we see an extreme amount of price volatility and lack of conviction in the market and in price action. Now, this was pre-cash open, but in the futures market, you can see everyone's got a different strategy. Everyone's trading a different way, but there's a lot of angst in the market. And we may work through that and work higher, but for me, the extreme volatility as internals are degrading, as we're at all-time highs with the lack of conviction is here's another example of people just jumping quick and trying to get out of those contracts and then kind of work its way back up. So that was the effect of the CPI number. PPI out today, again, hot. PPI came in year over year at 3.5% versus 3.3%. And then ex food and energy, 3.6% versus 3.3%. All of these numbers, 4.3%, 3.3%, 3%, 3.6%, all well above the target that the Fed had at 2%. And now you have Powell up on Capitol Hill, who testified this week saying, we're in no rush. Inflation may be sticky. There's no need to cut rates here. We're not sure. So a real change of attitude from September heading into the November election, and him saying inflation's under control. We're going to rip 50 basis points off and get this thing going. And then 2 more 25 cuts, getting us to 100 basis points in cuts, which has done absolutely nothing for rates and nothing for inflation except fuel it. And now all of a sudden he's like, well, maybe I was wrong. Maybe we're not okay. And as Yellen's, waving as she leaves the Treasury after creating $16 trillion in debt and says, hey, you guys might have a You might have a debt issue you want to look into. So all the same, it's kind of all evolving. Here's some market snip, and I think where I'll leave it with this, and then go into inflation because you had some great charts up this week, and I want to look at it for sure. Um, I firmly believe we're not going to break to really any new all-time highs. We may start to butt up against 60. We're at 6,100 now on the cash, but we may start to butt up again and kind of push a little. But we're topped out. I truly believe we are topped out, and I say that because of a lot of anecdotal data, and I say that because the model and the internals that I follow, that I trade, are showing an increasing weakness underlying in the market. One thing that I read today and talked to a few traders today, we're seeing a little bit of a push today, and the Trump headline bombs are definitely a real thing. But there could definitely be some derivatives action that's overflowing and creating kind of synthetic buying in the market. So
Hmm.
without going into it too deep, if you have people that are trying for whatever the strategy to buy calls rather than take outright exposure, take a more limited risk exposure and calls to the upside, understand that in the options market, if you have a market maker selling those calls, so if you're long puts or short calls as a market maker, you need to hedge that negative gamma, negative delta, meaning that position will hurt you if it goes up because you're negative delta now. You have to buy stock. So it's derivative exposure, trying to kind of delta hedge their positions that they're selling out on the calls by buying stock. So let's see how that works out and how that pans out. I think that's some of what's going on. But again, a real lack of conviction here. And these inflation numbers are definitely a real thing.
Yeah, 100%. And I would throw on there as well. Not only, did you see things like PPI that you mentioned come in really, really hot today, but on top of that, the previous months were yet again revised higher. So these initial reports, when it comes to inflation, it's always worse than it looks like. Just like the jobs reports always get revised the other way, they get revised down. Things are always worse than they initially appear. But and unfortunately, people a lot of times don't pay attention to those revisions. Kind of, to put it in context, the monthly uptick in wholesale inflation was 0.4% for January. But if you don't include those revisions, in other words, how much was December revised up? It's not 0.4; it's 0.6. That's a pretty big increase, right? That's 50% of a faster rate.
Yep.
So again, the inflation problem never went away. It's not going away because the underlying causes were never resolved. And interestingly, if you look at both the headline for not only wholesale inflation but also retail, if you will, or consumer inflation on the CPI, both of those the annual increases have been rising steadily each month since the Fed cut rates that you were just talking about. So again, we never solved the problem. In fact, last year the Fed started making it even worse. So it looks like things are going to continue getting worse before they can get better.
Yeah, just incompetent. It really is incompetent. We're
Mm-hmm.
going to go next week I'm sure this will still be on the deck. Um, I want to run through, I want to put together or find the best chart and you had it up. We had it up a couple of months ago. I think you had brought it up. That overlay between today and the 70s as far as what inflation did. And we're basically rhyming with it, if not following it almost exactly. The
Yeah.
correlation's tight, and we're about at the spot where we're starting to uptick, which is exactly what's happening. So there's definitely a real concern here as far as inflation goes, and the policies that have been kind of laid out and disrupted or caused the problem. Those policymakers and the Bidens, the Powells, the Yellens are gone, and now everyone's like, well, President Trump said on day one he was going to lower prices. Okay, President Trump said on day one he's going to get prices down, which means his policies are going to be implemented. He's going to start to fix the mistakes that were made. But there's got to be a spread in time between those policies being implemented and the effects of those policies being seen and felt. And that's
Exactly.
and that can't
Exactly.
come to terms with that. Well, they're the same people, singing songs out in front of the Capitol. They're being paid by us to go and legislate, but they've decided to write, cute little rhymes about um, budgets and numbers. And Elon Musk, who smarter than his IQ is higher than all of them added together, but that's another story. Consumer prices. You put up a great chart, and we'll lead into that on food, energy, and CPI. So let's pull that chart up. I want to take a look at this because I don't think people typically realize we feel it. even though we were told it wasn't real. But these numbers are massive. Are these the numbers for the past 4 years under Biden, or are these longer than that?
Exactly. Yeah. This is just the last 4 years. Doesn't stretch back any further than that. So it's January 21 to January 25 when Biden was inaugurated until the end of his term. And I know some people say, oh, well, Trump was president for a third of the month. Okay. Well, again, none of his policies had any time to actually take effect. In fact, he still hasn't even implemented a lot of his policies, and here we are, 3 weeks later. But the other thing is that the survey data used to compile these reports is conducted 3 times during the month. Once at the very beginning, once towards the middle, and then another time towards the end. So virtually all of the data that goes into these monthly consumer price index reports was already collected before he was even sworn in anyway, regardless of whether or not he implemented policies on day one. So, these are very much, Biden's numbers. This is why we use January of the inauguration year as the baseline. It doesn't matter who's becoming president. So, yeah, look, these are regular consumer staples here. This is not caviar we're talking about here. Again, these are staples. You're looking at butter, you're looking at flour, sugar, peanut butter, things that people rely on. Obviously, eggs is usually a huge source of protein for a lot of Americans, especially people on the lower end of the income scale, because it's traditionally such a cheap way to get protein. Egg prices have more than doubled. Now, I understand that there was a big increase in the last month, because of things like the avian flu that we've talked about, and some of that was simply different people being very overzealous about needing to cull flocks. But whatever the case may be, if you look at the whole consumer price index, eggs make up less than 0.2% of that index.
Okay.
So for those who are trying to blame, the 22% rise in prices under Biden, so much of that is eggs. No, it's not. It's a very, very tiny percentage. Again, it's 0.2% of the whole index is the consumer price for eggs. So even if that not just doubled, but tripled or even quadrupled, a 10x increase even, you're not looking at much of an impact at all on the overall index. What caused that was the devaluation of the dollar that we saw under Biden, and that was done in order to pay for all the government spending.
Yeah, that's actually really interesting. Very anecdotally, the eggs are 0.2% of the index, and this is part of why. And honestly, I don't think that the mistakes that were made and the revisions that had to come in, whether it's unemployment numbers, employment numbers, non-farm payrolls, or inflation numbers, I can't believe that that was all done in an upfront way. They can't be, they couldn't have been that stupid or that off without some nefarious activity or some angle to try and hide exactly what was going on. That's my personal opinion. But this is interesting because we talk about how things feel very different than what they're telling us. So if eggs are only 0.2% of the CPI calculation, but they could be 50% of the protein intake for a given family, especially
Right.
on the trade down from beef, from chicken, from pork, which was more expensive.
Mm-hmm.
Um,
Mm-hmm.
an item like that might be half of the protein that you're going to take in or 3/4 of the protein you're going to take in as a family because of the fact that it's such a cheap item. So it's not making up 0.2% of my basket when I go to the supermarket. It's much larger, and therefore the pain is much greater than what the pundits and the government is telling us as far as CPI data and how they calculate what their methodology is.
That's a great, great point. And it speaks to how so many of these official statistics really undercount the pain for the average American. I think it's a big reason why you have things like GDP, which is fueled by government spending over the last several years. It's been putting up blockbuster numbers, and then when you poll Americans for about the last 2 years, more than half of them pretty consistently have said, when asked about are we in recession, more than half have said yes,
Yeah.
because their own personal financial situation, for exactly the reasons you just described, Anthony, their own personal financial situation has deteriorated. So to them, yes, the economy is doing worse.
Absolutely. And I would say, as we're talking, I'm not listening to him because we're doing this, but I'm sure President Trump is talking. As much as I love him, the tape bombs are killing me. And the market is starting to kind of fade off a little bit here we'll see what intraday looks like, but we're starting to see a little bit of a hit. We'll see where the market's at end of day. Futures at 66,097 now. Let's play a little game. We'll see we'll see where they are when we end the podcast. So if we go to energy prices, this was the next one that I thought was pretty interesting. Very upfront, very basic, not basic, but very forward and easy to view for, everyone, including myself. Um, Obviously, the policies were wrought with regulations. There were lands taken away. There were regulations placed on our energy industry. Probably the worst. I would say this was the worst 4 years of regulations and of relationship between the energy sector in the United States and the government in DC.
Hmm. Hmm.
Um, so we look at what exactly the results of that have been on this chart. Um, yeah, go through this a little bit. Gasoline all the way to heating oil. This is amazing. This is
Hmm.
crazy.
And so much of these, I mean, obviously gasoline and diesel and home heating oil, those are all things that are derived right from oil, whereas obviously nat gas and propane are going to be from nat gas. Electricity is a combination of things like primarily coal, nat gas, and then also a handful of other sources like nuclear, for example. But basically, what we've seen is the regulatory environment that you just described, which was absolutely appalling over the last 4 years, imposed costs on the industry. Then you also had the imposition of direct costs through things like the Inflation Reduction Act. The name of that was an absolute lie, by the way, in part because it imposed new taxes on the coal, oil, and natural gas industries,
Yeah.
all of which were just passed on to consumers in the form of higher energy prices, including higher utility bills. So let's say we take all of these energy sources, Anthony, and then we apply weights to them to get a weighted average to see, all right, what is it going to cost the typical American family to stay warm this winter, to keep their homes warm today, January 2025, compared to January 2021? What you find is a 33% increase. So the cost to heat your home has literally gone up by a third in just 4 years. This is what happens when you have anti-energy policies.
Yeah.
You are not going to see the supply of energy keep up with the demand for energy. And that means you're going to get higher prices, pure and simple.
Yeah, it's a real thing. I mean, this is, it's really it was the attempted destruction of an entire industry, and in my opinion, it was extremely damaging to national security, to the economy. It really was a driving force of inflation,
Yeah.
on top of a plethora of other really bad policies. And this is really where the drill baby drill comes from. Whether I don't think everyone's going out and drilling. Our E&P guys in the U.S. are going to go out and start drilling tomorrow to find more oil and produce more crude, and drive the price of their commodity lower. I think that's part of the challenge of the idea of bringing energy prices lower to help with inflation. But that said, this has been a debacle, and this was core to this Green New Deal joke
Yes. Yes.
of
Exactly.
of
Hmm.
hurting the everyday American for what the very few think is the top priority or the moral high ground, which, to be perfectly honest, is neither here nor there. It was trillions of dollars spent and wealth destroyed in this country for basically an ideology, no reason, just grandstanding.
Right.
Um,
That's such a great point, Anthony. We literally took resources away from reliable American energy and put it in unreliable places like wind and solar, things which are net losers in terms of both electricity generation, but also in terms of earning a profit. You're spot on.
Yeah. Again, subsidized companies that have been gifted trillions of dollars, hundreds of billions of dollars to exist at a loss, to
Hmm.
exist and not be able to make a profit and not be able to even produce anything near the amount of energy or energy that's reliable in any way in the country. And then the producers of reliable clean energy have been not only ostracized but punished. It's been it's quite a thing. I hope as we move along and we start to come out of this, they peel back the onions there as well, because the layers of the onion there, because it's been almost treasonous what they've done to the energy industry in this country. Um, Inflation is transitory, they said. This is our next chart. Inflation is coming down, they said, but your wages are rising, they said. So run through this with me, because we all know that that's not exactly what happened.
Yeah, this it's just all the lies that we were told over the last several years, right? First, there was no inflation, then it was inflation's transitory, then inflation was good for you somehow. Then they declared, victory on the war on inflation. Meanwhile, it's still here, it's still making us all poorer. And on top of that, the idea that somehow, well, it's fine, right? High prices are fine because you're getting paid more. No, no, it's not fine because the prices have gone up faster than your wages have gone up. This is why people feel worse off today because they are worse off. It's also why when they talk about corporate profits being at a record high, how that's not really indicative of things being better or of wealth generation. Because if you adjust the average corporate profit rate or the average amount of corporate profits, I should say, for inflation, you find the exact same thing that you find with the average American's weekly paycheck, which is that things are smaller. You are worse off today. And so when we look at, for example, food prices, they just blasted through yet another record high in January, the last month of the Biden administration, and people's wage increases over the last 4 years have not kept up with the higher cost of food. And again, going back to something we talked about earlier, Anthony, that you brought up, these are just the official numbers. In reality, what the typical family is spending on food, I mean, that amount has gone up even more, which again helps explain why people say they are even worse off than the official data purport to be.
Yeah. And I would go one step further, which is your step. I'm going to steal this from you as we wrap it up. You talk about real wages not keeping up with inflation, and that's a real thing, and that's true, and that can be proved with the data. Whereas when Biden stands up and says everybody's wages are increasing and everything's great, that's grandstanding. That's just him pontificating with nothing to back it up. But what's really interesting, and you've spoken about this quite a bit, and I think it's fantastic when you talk about people, the boomers and those retired now in this country who are on a fixed income.
Mm-hmm.
You had a blurb about, we don't have the graphic, but I thought it was fantastic because it's a group that we haven't talked about lately, and a lot of people don't talk about. We talk about the millennials, we talk about Gen Z, a little bit of Gen X, which is me and you, I think, although you may be a millennial, I'm not sure.
I'm a perennial. Let's go with that.
But the basket of goods typical, and you did this, you put this out, the basket of goods typically purchased by a baby boomer in retirement, the
Mm-hmm.
cost of that basket on average is up 22% over Biden's 4 year term. And correct me if I'm wrong.
Right. No,
So,
that's right. Yeah.
right, in that case, there is no increase in wages, real or fake or otherwise. You're on a fixed income and you are getting killed every time you buy something that you need, whether it's gas, whether it's eggs, whether it's, you know, milk, whatever, bread, you're getting crushed and you have no way to make up that gap. So you are literally being squeezed every day because of the ridiculous policies and debt creation that occurred under Biden.
Exactly, Anthony, 100%. And then on top of that, you throw in that so many of these folks, they thought they were doing the right thing, transferring all their assets to fixed income, right? And the bond market under Biden saw its worst 3.5 year run in at least a century. That's not an exaggeration. So many of these folks just got absolutely crushed on both the income side and on the expense side of that ledger, so to speak. And that's why we've seen an increase in things like a number of retired folks who are picking up part-time work because they need to supplement their income. You're also seeing a huge increase in the number of people who have not yet retired but are making hardship withdrawals out of things like their 401k plans. That's actually at a record high right now. It's because folks literally can't make it from paycheck to paycheck. They can't make ends meet. And so they're even having to dig into their devalued savings. Not a good situation to be in. And then we also get data just today, actually, from the New York Fed showing household debt smashed through $18 trillion last quarter. Again, a new record high. And at the same time that all categories of consumer debt, I should say, increased in that report. We're also seeing things like delinquencies on credit cards, on auto loans. All of those are ticking up, and they're now at the highest rate since the global financial crisis. So it's hard to say that the consumer is in a good place when we're getting all these warning signs, all of these red flags.
Yep. And I'm gonna tag along with that. We actually are speaking about it today with a couple of guys. Um, consumer credit for December exploded. It was a 40 billion number. It was marked up. The estimate was 15 billion, 15
Mm-hmm.
billion, right? And that brings revolving debt in the U.S. per household total at 1.4 trillion. And just to put that in perspective, that 1.4 trillion number was 600 billion in the year 2000. So debt is exploding as savings are decreasing, and we'll fast forward now to the December number and where we are in Feb of 25. I have to check my date like I didn't know. So you have debt exploding. Obviously, the consumer, and we talked about this all through December, was the consumer going to pare back? Was the consumer actually going to use credit to get through the holiday? And I think well, the answer is they used credit, obviously.
Mm-hmm.
And I think part of the use of credit was that's the only way they have to do it at this point. There is no cash on hand. And I do think that the sentiment uptick because of the Trump win gave people a little bit more of a reason to be like, oh, you know what, we'll get the extra bottle of wine and we'll get the extra pair of shoes and which is fine. But the fact remains is we have consumer credit and consumer debt exploding. We have savings rates dropping. And
Mm-hmm.
because of the 10-year, because of inflation, because of mismanagement as far as monetary and fiscal policy and top-down Bidenomics, we have rates high on all these loans. The revolving credit rate that they're paying on these credit cards is the highest it's ever been.
Right.
As the balances are the largest they've ever been. There's some work to do here, and it definitely is concerning to me. On the investing front, it's something I watch very carefully. And on the personal front, it's a concern. So great job going through the inflation numbers here. I don't know, man, I'm going to toss it to you to close, but this was all you today. And the charts are fantastic.
No, you're good, Joe. Hey, look, Anthony, we're at a bit of a crossroads, right there, and the question is going back to what you mentioned earlier, and I'm sure we'll get that next week. The overlay of inflation today versus the 70s and 80s. The difference where we are right now, as inflation is starting to pick up again, and we could be heading towards that second spike, even larger than the first. The difference is we have Trump in the White House and not Carter. Yeah. So it's not to say that this is all a foregone conclusion that delinquencies are going to continue skyrocketing on consumer debt, that the federal debt's going to spiral out of control. Is that what happened before? Yes. But here's hoping the policies are going to be completely different this time. And so the profit end of the equation will also be completely different. So we're going to keep our fingers crossed, and obviously we'll give everybody the latest update next week, especially after the president's presser today.
Today he has a presser every day. It's not. All right, update on the futures. We are literally dead even from where we were before, but I have a feeling we're going to be lower by the end of the day. We'll see. I might be talking my book and the positions I have on right now. I might not. I'm not going to say. Amen, brother. Well done. Thank you very much. I'll see you soon, and I will definitely be here next week.
Till next time, Anthony. Always great to be with you.